Ladies and gentlemen, thanks for coming to our event this morning. I'll hand it over to each of them to tell you a bit more about themselves, and then we'll get going with the discussion.
My Bitcoin journey started in 2012 when I took a crazy punt on a little thing called Bitcoin and sent $10,000 to a Chinese bank. What I got back was some Bitcoin, and that began a very interesting path. So I'm the chairman of CoinShares. CoinShares is a digital investment bank, and we are one of the larger groups in the world. We're operating in about 7 jurisdictions, and about 3 of those physically here in London, in Jersey, and in New York City.
I'm Miles Milston, founder and CEO of Globacap. We founded Globacap with the premise of creating a security in entirely digital form, and blockchain was the mechanism to do that and automate the end-to-end process.
My name is Joe Omke. I'm a principal at Promontory Financial Group, which is a wholly owned subsidiary of IBM. We're a global financial regulatory consultancy where I focus on blockchain and European data privacy and data protection issues. I suppose I'll be the voice of the regulators today.
What we want to talk about today is where crypto goes from here, but I thought maybe if we could start with how we got to where we are.
I think if you look at the flow of what we might talk about here, I'm going to talk about the path to date and where we are, the new sort of chapter we're embarking on. Miles is going to tell you how he's actually gone ahead and done that, and then Joe's probably going to tell us why we can't do it. The visibility over what goes on in the cryptocurrency space, digital asset space, blockchain space, whatever you want to call it, is quite tricky. It's very geographically diverse, it's stylistically diverse, and that information is not well reported and not well disseminated anywhere. The quick and dirty summary of this, as far as I interpret it, is as follows. Post the financial crisis, the door was open to cryptocurrency, and cryptocurrency in the form of only of Bitcoin at that time was a reaction to the financial crisis. It was the tech people coming to the financial business saying, you know what, we're going to try this a slightly different way. And that was the essence of the Bitcoin movement. The Bitcoin movement has been and still is a form of disruption for gold and for money, for fiat money. That is Bitcoin's base use case. And we can argue till the cows come home how it doesn't work and how it's going to pollute the planet and how they're populated by money launderers, but that is its core functionality. And as we went through, a slow and then ever increasingly rapid evolution with Bitcoin, around 2015 along comes Ethereum. And Ethereum changed, Ethereum made the cryptocurrency space turn from monodimensional to two-dimensional. And people began to realize that you could use the Ethereum blockchain to form capital. And that ushered in the ICO wave. And it also ushered in many other forms of blockchain following after the Ethereum model. But the ICO move was pretty dramatic, and without any question, a bunch of tech companies managed to raise very significant amounts of money to fund their projects in a totally novel way in a very short space of time. And that model was soon abused by a number of players, and it got to a place where I think the Ethereum Foundation would never have imagined a path they might have seeded. And the SEC and other regulators understandably came down pretty heavily on that. What is happening now is that we're beginning to see the emergence of the so-called security token. Along came some ideas to take the existing regulatory framework that we have, for example, in the United States around Reg D, Reg S, Reg A, Reg A+, Reg CF, and use those regulatory safe harbors, which usually will involve some kind of prospectus, some kind of exemption from the Exchange Act, and normally be deployed in the form of a share certificate. But rather than do that, go through that process, fulfill the requirements of the prospecti that would drive those asset creations, but make the form of that security a smart security. Why would you want to do this? In a nutshell, this is a way to make private securities, shares in private companies, liquid, transferable, and transparent. So in summary, wave 1, Bitcoin disrupts money. Wave 2, Ethereum disrupts stock markets. And wave 3, a possible digitized, blockchain railed security token environment. In terms of the regulatory and the business reaction to this kind of development, it's quite distinct from waves 1 and 2. Wave 3, if there is to be a widespread tokenization of hard assets, real estate, and private shares, this is a business that legacy financial institutions, investment banks, insurance companies will not be able to avoid. The concept of a security token framework is actually a win for regulators. And so for those two reasons, the sort of compulsory engagement and the win for regulators, I believe that this is going to be a next and very powerful movement in the crypto space.
If we could take a step back, perhaps, for a second, and I'm not sure how much of the room or any of the viewing audience actually really understand what blockchain is and why it allows for this transformation in securitization effectively. Imagine you have a share listed on the London Stock Exchange. That share is really a tradable representation of a shareholding. It's not the actual shareholding. When that share gets traded, a series of processes happen, clearing and settlement, which eventually update a centralized register, stored in one specific database at a central securities depository. And when that register, when that list of shareholders gets updated, that's when the legal transfer of ownership has actually happened. So what blockchain is, to link that together, is instead of having one single database, you can take that database out and distribute it across a number of different servers or participants in the market. It all ties together. Every transaction is linked together in a chain, hence blockchain. And it's done so in a mathematical way where everybody trusts that the data that's there is integral, that it's completely intact. And in order for someone to hack that, because it's all linked, if you want to hack an old piece of data and cause some form of fraud, you actually have to go in and change every single link along the entire way, which is mathematically impossible with our current technology. So when you look at it, Bitcoin in reality, for all that's talked about, it's actually the most secure database that we have on the planet right now. And that means that you now have a very powerful form of completely digital securitization where it becomes economical to securitize any otherwise private asset that would have been difficult to or expensive to create in securitized form, which is a very powerful thing. And that unlocks a huge amount of economic value from around the world. We performed the first proof of concept, if you like, with our own company, whereby we call it tokenization or securitization. We created our capital structure in blockchain form. We took an investment from a number of jurisdictions and across a number of different geographies and currencies around the world, facilitated that through our platform, generated that our entire equity shareholder base, our register, in blockchain form, created those securities in blockchain form, and then also trialed the transaction from two parties within that, and documented the efficiency gains that we had as a result.
So Joe, it's a win for regulators. It's already happening. There's no problem at all here, right?
That's right. There needs to be a shift in focus and a shift in how we perceive financial regulation and regulators, not necessarily as the adversary or as opposed to innovation and opposed to things that work, but rather how we can foster innovations that work for everyone and are not a threat to the safety and soundness of the global financial system. There are certainly challenges when it comes to crypto assets, and we've already got plenty of evidence suggesting that there's a tremendous amount of fraud in the cryptocurrency space. There are plenty of illicit uses by bad actors that states, regulators, and I think the general public, has an interest in curbing. And so those things need to be taken into account and need to be considered, and not just necessarily the sort of utopian vision that this is going to be a cure-all for what ails the financial system. The
illicit use of Bitcoin is something that's been well covered, and I think those kind of volatility and money laundering issues, are well known and maybe not completely addressed at this point. It's the things that we haven't really experienced yet that I imagine might become problematic with the security token environment. And that is, as we talk about the transferability and liquidity of these previously private assets, we're not necessarily addressing what the public market already does for those transferable assets in terms of insider trading, market abuse, orderly market constrictions, directors' obligations, and all these things which we take for granted in a public company because the nomads and the brokers kind of are the gateway to get to the exchanges, are the gateway to get to the public market. Arguably, you can now get to a public-like security easier, but you're not necessarily going to have those protections. Those are the areas I'm more concerned about when it comes to security tokens. And I'd like to see a lot of the unnecessary work in the public securities markets taken out, and a sensible approach to the sort of principles that those public markets promulgate, but have it encoded in the securities in a smart way rather than the clunky way we have now.
The key in my mind here is to say, okay, rather than, even though we're creating something really novel, and this is a new way of doing things, rather than saying we now need new regulation to go along with that, actually what we're doing is we're still creating a security, which fits into existing securities legislation. So how can we actually use existing legislation and work within those boundaries? And I feel that's what we've done to date. Now, that being said, there are ways that we can make that more efficient, and we are dealing with a new technology that allows for transactions to happen much quicker, for regulators to have more insight into those transactions, for a lot of those back-end processes to be completely automated, which takes away opportunities for fraud in the first place. So there are really good elements to this technology, and there are therefore ways that regulation can be improved to allow for more efficiency in the system while still holding protection. Thankfully, in Europe, most regulation in securities world is relatively aligned. There are differences, without doubt, in terms of financial promotion and how you target consumers in different countries, even within Europe. Take that further afield. What we're trying to do is build a mechanism or a platform by which you can have a global security offering, and you can have a small, mid-sized, eventually large company do a capital raise to that global audience and have liquidity for those securities in many different jurisdictions around the world.
Joe, how realistic do you think that is to get to a level where regulation, you can think of it on a global level?
I think it's a challenge. I think just thinking about it from the U.S. perspective only, it's a challenge to get cohesive regulatory stances just within the 50 states and the federal government. I think that there is a level of cooperation and communication that's happening at the global level, which is really positive, and sort of, if consensus hasn't yet been reached, or maybe it never will be, but I think there are consistency in terms of how you approach problems, and maybe you arrive at different solutions. But I think those issues are being approached and tackled in the same way. And I think that part of what makes this a very challenging space is, first of all, educating regulators and working hand in hand with them to make sure that they understand what the product is, who are the people you're serving, and what are those risks.
So just to talk a little bit about where we are today, there is no tokenization currently. What I can tell you is this is basically a three-step process. Step one is carve out this regulatory safe harbor in which you can actually issue and create the securities to start with. Phase two is how do we make the tokens operable, and operability, brings questions like ID and verification and audit trail and all this kind of stuff, which would already be prescribed inside the regulations. How do you then make these tokens interoperable? And interoperability, you're starting to think about a regulatory environment in country A, a regulatory environment in country B, and the intersection of those two environments, if there even is an intersection, and populating that with your interoperable tokens. So it is pretty early days, but I think what's happened in the last 6 months is that first part, the regulatory certainty part in certain subsets and areas has been formed, and there's a lot of work going on in the operability phase not so much in the interoperability phase yet.
How comfortable do you think regulators are in this entire space?
Obviously, the answer is going to depend on the regulator, and I think that some are further along than others. It's always a challenge in regulation because it's sort of inherently backward-looking, right? Like it's difficult to figure out what the next crisis is going to be. And so, the result is that you create regulations that are designed to solve, the problems you know about. I think that there is a real value in having regulators have the tools and the technology and the people that they need in order to understand exactly what's happening at the cutting edge of financial services.
In my view, there are two parts to the FCA. I feel like there's the part of the FCA which is the FCA, and there is clearly a focus on protecting end users and consumers, and therefore a slow transition. But that being said, there is the FCA Sandbox, which is an incredibly innovative team and process. There is a discussion paper that the FCA Sandbox team released on blockchain distributed ledger technology earlier in this year. It's an amalgamation of all of the learnings that they've had from other companies that have done blockchain related tests in the FCA Sandbox. And there's some really interesting findings in there, and also some really interesting views of how beneficial certain aspects are to consumers. So on the one hand, yes, we can protect consumers more, but the other focus is also making the environment better for consumers, and be those institutional or retail consumers, and saying that if there are cost savings, if there's a better chance of oversight, all that sort of stuff, then that's a good thing.
You're seeing regulators around the world taking opinions, and maybe they're not fully fleshed out yet. There's still a lot of a wait and see approach to regulation in this space, but I think you are seeing regulators around the world that are producing reports and thought leadership from a public perspective.
The way I would look at crypto going forward is, this deployment, as we've been talking about today, is very much what I call the crypto evolutionary branch. There is still a very strong crypto revolutionary branch, fully decentralized exchanges using zero knowledge proof coins. These are pretty much non-interdictable, and if there's an ecosystem that develops there's nothing really anyone can do about it. That's the kind of revolutionary branch. In a nutshell, think about these currencies in a couple of ways. One, blockchains are transactional superhighways. They're utilities. And so, Bitcoin is your money, Ethereum is your, stock market. Those are the main highways. And as you go then down, you have some runoff highways. So, Ethereum Classic will be a runoff for Ethereum, and Litecoin will be a runoff or a B road for Bitcoin itself. And in times of very high capacity utilization, we saw Bitcoin fees go very high. That correspondingly drives transactions and users to potentially the Litecoin network. Those are the two dimensions. The third dimension is app coins, and app coins are spawned on top of various blockchains. These app coins can be utility tokens, pretty much only these days. And the question there is, are they actually currently or prospectively going to give you access to a system that you want to use? People do want to use Huobi, people do want to use Binance, people do want to use the Bancor network token, and therefore those tokens have value. So all that's happening right now is the world's figuring out which of these transaction superhighways are actually useful, which of the transaction superhighway side roads, B roads, are useful, and which of these app coins are actually giving you access to something I care about. And that will wipe out 90% of crypto assets by the time that's done.
The sort of, utopian crypto future, what's the main obstacle? What's the thing that will get in the way right now?
In order to answer that question, I think you need to think about it in two different parts. And one is the crypto asset world. And I say crypto asset because I'm talking about actual crypto assets, which you could kind of loosely call currency. Then what I would call securities. That's a representation of all the physical real-world assets that are out there. What does the future look like? Well, in real terms, if we skip forward 30 to 40 years, the politicians, the regulators, the business leaders that are in power in 30 to 40 years' time will have been teenagers now, effectively, that grew up with crypto. So their view, their take on it is going to be entirely different. It's not going to be a question of, is this legitimate, is it not? It's just going to be, that's the way the world works. How do we get to that point? Well, You work within current regulations, as we're doing. On the flip side, you have an evolution of crypto assets where those 2 points merge, which is probably in 12 to 24 months, I think was when we'll see a real explosion of a new world, so to speak.
It doesn't really matter where you think crypto is going to go in 30 to 40 years. Right now, crypto is here, and there are plenty of use cases being developed. And I think that the challenge for the regulators is to figure out, what are some common sense approaches for how to deal with the world as it is, and how to lay a strong framework for where we might be going in the future. I don't think that you will see a rash response. Regulators are still regulators, and they tend to, unless there's a crisis that demands an immediate response, they tend to sort of move slowly after a lot of information gathering has been done.
If we look at the FCA sandbox, because I think this is a really good indication of where things are going, where the innovation is coming, and where it's focused. We're in cohort number 4. There are 6 monthly cycles. Up to the end of cohort number 3, the first 18 months of the sandbox, if you like, there were 22 firms that did blockchain-related tests. And out of those 22 firms, 20 of them were focused on payment remittance. And this is really interesting in my opinion, because I think this is the real first application of blockchain in its truest form, which is as a mechanism by which to make micropayments, or any kind of payments, but at a very, very efficient manner. We're now about to see the first versions or iterations of that in the real world scenario, and there are quite a few startup companies which are doing that. This sandbox that we're in, cohort number 4, there are actually three firms, including ourselves, that are doing securities-related blockchain tests. So if you consider a time lag then between where we really see that taking off, in 18 months, I think we'll actually really start to see that propagation out in the market.
Daniel, you made the reference to Bitcoin being a disruptor. What is it disrupted? Nothing. It's been around 10 years. It's achieved nothing apart from speculative highs and lows.
Whether you like it or not, whether you can rationalize it or not, you look at something and you go, it is just here. And I would argue that is, for better or worse, that is the case with Bitcoin. If you want a specific use for Bitcoin, I think we're actually, one specific use for Bitcoin, I think we're actually, hitting on it right here today, which is this. If you believe there is a value arbitrage between 5 and 10p companies in private and 25p companies in public, and that's actually kind of the gravitational pull for this kind of activity, there is little doubt in my mind that as you go to that third phase, which is the interoperability of these different exchange venues around the world, I can't imagine anything else other than Bitcoin being the actual settlement currency for those transactions. Secondly, the Bitcoin network itself forms the basis of the IT security for a settlement system as well. If you're running databases off to the side, potentially, with all your transactions and your customer data and your constitutional documents, and you are condensing or hashing that data and distributing it to different servers to make it secure and unhackable, you need somewhere to attest what the state of your database and your data is. You need to do that in a non-revealing way so you don't breach GDPR. So you hash the state of your database and you embed that in a Bitcoin block or successive Bitcoin blocks. So Bitcoin has these two functions there. Number one, it is actually potentially the backbone for the settlement system, but also the native settlement currency.
There is a crypto mechanism that will become the universal settlement currency, let's call it. Do I agree that that's Bitcoin? I'm not convinced by that. There are also entities that are working on a crypto pound, a crypto dollar, a crypto euro. I think when we see those, that's going to have uptake on the institutional level immediately, because there are significant efficiency gains on that front. If we have that, then do we then need to have a Bitcoin as a universal settlement currency? I don't think so. I think there's always going to be a place, personally, I think there's going to be a place for Bitcoin simply because it has such a brand catch already that I don't think anything's going to be able to displace it in the long run.
me as an acquirer, let's say a private equity company, if I want to acquire a small to medium-sized business that has their shares on the blockchain, how can I make a tender offer when, firstly, I don't know who even the shareholder is? I cannot make a tender offer for all of the shares at once and make a successful acquisition unless it is centralized, removing the need for a blockchain entirely.
I'm going to answer your question specifically on a public blockchain structure to give the full proof of concept in terms of security tokens, let's call them. So on a pure public blockchain structure, it's still possible. And the way that it's possible is how we built it is you have a one which is that tradable representation, right? That's the same thing which would be listed on a London Stock Exchange, for example. It's a tradable representation. The other component is the ledger, the record of asset owners, and those two are interlinked. So when you have a trade in one, it automatically updates the other. Great. Now, you can protect the data in that asset, in that smart contract that is that asset register by encrypting it, by only allowing access to certain points. Now there's a risk there because that is still on a public network and people can decrypt that eventually, which is why we went to a private network. But all that aside, when you have this structure, what you can actually do is in that tradable token, bearing in mind that the register, that's the real legal ownership here. So that tradable token, what we can do is, and what we've done is, built in certain functions within that, such as a whitelist, so that any recipient has to first be pre-approved by whatever system is being utilized. That means that you can be sure of KYC and AML and that sort of stuff. Secondly, and more importantly to your question, a blacklist in there as well. So any sender can only send their tokens if they are not on that blacklist, which means that in an AML context, if someone suddenly appears on that list, you can add them to that blacklist, block them sending it. It also means that you can block or bar those tokens at that specific address. You can burn those tokens and or reissue them to a different address. Now, that means that if you have a tender offer, you have somebody that buys 50% of a company and they're a drag-along rights and they want to buy out the rest, you can actually then block every single token that's at every other holder's address, burn them, and reissue them to that new acquirer and pay those people accordingly. Now, could you do that in an unregulated context? No, absolutely not, because that's absolute fraud. Could you do that in a regulated context? Yes, because any company like us, as an arranger or a custodian, in either case, that went and did that on behalf of a company, and we did that fraudulently, well, then we as directors of the company would go to jail. So, you know, there is a regulatory mechanism by which that works.
How do you achieve liquidity in even more decentralized, dispersed market for tokens that nobody's heard about, and the liquidity is, what, 200 tokens a day?
What I know for certain, if you're doing a private equity investment or a Series A, you may not get any liquidity for 2 to 7 years after you issue or buy such a security. A lot of stuff happens to a company in those intervening years, and in a private environment that is kind of never heard about because it's not disseminated publicly and maybe not even to the shareholders. It doesn't make any sense for me to tokenize Apple shares. Apple trades exactly perfectly the way it does. But what does make sense to me is to have a private company that I couldn't access before at all, because I'm not in the private deal world, where a small fraction can be traded efficiently, where there is some liquidity where there was no liquidity and some information where there was no information. You're talking about making smart securities, and smart securities that, like other tokens, can be programmed to do other things. So on top of their, a little bit of liquidity and a little bit more transparency, they may become more accessible in a technological sense.
Does the panel think that global STOs are possible, and if so, when can we expect them to come about?
That's already happening. When do we actually see them trading, and when do we see a secondary market? When do we see that global liquidity start to happen? I think we'll see that in the next 6 months. There's T0 and a couple more entities in the United States. There are a few entities in Europe who are trying to go down that road. They're a little bit behind the US. But within the next, I would say 6 to 12 months is when we really see that start to take off.
Well, there you have it. I suppose it's either going to be next year or never. Thank you very much.